You take a different approach and how you work with your investors, so it'd be interesting to share with the group.
Well, I think what Rob's comments were interesting, and Ali, of course, has the great fortune of being in the U.S. with non-recourse lenders. We don't have that in Canada. Sure. It's a very fundamental difference between this side of the 49th and that side of the 49th, and so it affords very different opportunities. I think Rob's absolutely right. I'm not a fan of REITs. I think that over the past 15 years, we've had accredited investors, ultra-high net worth investors, and family office invest in my company, directly invest into our projects. And this is quite interesting. You know, 15 years ago, I used to have the money manager who sat in front of the family office and would sit in front of me and say, you know, Frank, the family office business is not in the get-rich business. It's in the stay-rich business. I didn't really know what that meant, but it sounded good. So I said, okay, great. What does that really mean in terms of the capital? What they'd say is that of all the money that's in the family office business, if you think about asset allocation, we'll take 15 to 20% of that and put it into real estate. Of the 15 to 20%, we'll take 2 or 3% and put them into private deals like minor alleys. And what we've seen over the span of time is exactly what Rob talked about, which is a lot of the money that didn't go into private deals with good management teams and good project fundamentals went into the REIT business. And because REITs are pure plays, REITs are dead simple business models. There's not a whole heck of a lot of strategy behind them. So either the market's going for them or it's going against them. And if it goes against them, it's very hard to mitigate. So over 10 years, a lot of the REITs have pulled back. A few of the REITs, excuse me, have dramatically pulled back. And of course, you know, most of that institutional money was attracted because of what? This magical word called yield. Well, yield, ladies and gentlemen, doesn't create wealth and it doesn't sustain wealth. The only thing that creates wealth and sustain wealth is a combination of yield and capital appreciation. And so what you're finding is guys pivoting. So Rob's company realizing they got to get into development. Why? Because pure play REITs don't work anymore. You got to have a portion of that money going into development so you can turbocharge that return profile, so you can compete against the inflationary issues, against inflation grading, against the return profile. So no, I don't put any of our own personal capital into institutions. I love what guys like Rob do, but there's very few guys in the market who do what Rob do. And I think that placing capital directly into private companies that have great management teams and strong project fundamentals is where you get your best returns.
Okay,
you know,
go
somebody
ahead.
earlier on spoke a little bit about, I think they used a Blackstone example and a 15% yield on some of these REITs and other in the U.S. And as an individual who's lost deals or sold deals to those REITs, I completely agree. There's no way I would touch any of those because not the bounce that's going to be there, just knowing some of the assets that they've chased, the theory on our side is let it wash out because you may make a 5 or 6 or 7, you may. But in terms of the duration of the loss of capital or the potential further free fall, not to be a naysayer because we do deals, but it's something everyone needs to take into consideration as they make their allocations.
Thank you. Any questions?